This video is going to look at the basics of income tax, and I'm going to do this one a little bit different than the normal video because there's so many words and definitions that we need to cover, and this really is just the basics of income tax. The tax laws are hundreds, if not thousands, of pages long, and they change almost every year. So if you're interested, go take a tax accounting class, but we just want to get you an introduction to the definitions and the big idea of what goes on. So first definition is the gross income, and this is all of the income that you make for a year. So your wages, tips, any profits that you make from a business, interest or dividends from investments, or any other way that you bring in money. Now, when you bring in money, not all of it is taxed. Some of it is taken out of your paycheck before you get it to pay for things like retirement savings and health insurance. And you can also sometimes take out money to pay for healthcare expenses. There's a bunch of things you can take out money for. And these things are called adjustments. So the adjustments come out, and what's left over is your adjusted gross income. So to calculate your adjusted gross income, you take your gross income and subtract your adjustments. Other things that come out of your taxes are exemptions and deductions. So amounts that you subtract from your, these are amounts that you subtract from your adjusted gross income before you actually calculate your taxes. And we'll talk about these in a little bit more detail moving forward, but exemptions are a fixed amount per person that the federal government says you can take off your income, and deductions will vary from person to person. So to get your taxable income, which is what you actually pay taxes on, you start off with your gross income, then you subtract your adjustments from it to get your adjusted gross income. Once you have your adjusted gross income, you subtract any exemptions and deductions that you qualify for to get your taxable income. And it's just that taxable income at the bottom that you actually have to pay taxes on. And you can see why people try to get as many exemptions and deductions as possible to decrease what they have to pay taxes on. So for example, let's say that Karen earned $34,200 for her job, and she earned interest for $750. She takes $1,200 and contributes it to a tax-deferred IRA. She claims a personal exemption of $3,050 and has $5,400 in deductions. So her gross income is all the money that she makes. So it's the $34,200 from her job and the $750 that she made from her interest. So her gross income is $34,950. Then we take any adjustments out of that. So we take her gross income of $34,950 and subtract what she put towards the tax-deferred IRA. Excuse me. To get $33,750 as her adjusted gross income. And then from that, you subtract personal exemptions and deductions. So we subtract the exemptions and the deductions to get her taxable income. So while she brings in almost $35,000, she only has to pay taxes on $25,300. That's a big difference, and that will save her money on her tax bill. Now, when you file your taxes, you can file single, married filing jointly, married filing separately, or head of household. And head of household basically means that you are single, but you're taking care of a significant number of people, whether it's children or other dependents. And I am not a tax expert. Go ask your accountant what you should do. But each of these has a standard deduction associated with it and a set amount that you can choose to subtract. So let's talk about exemptions. We said that we subtract exemptions and deductions from our adjusted gross income to get our taxable income. So exemptions are subtracted. The more, the better. It is a fixed amount per person, and it usually changes by the year. Just for an example, in 2012, it was $3,900 per person, and you can claim it for yourself, your spouse, and all of your children, or whoever else is included on your tax return. So exemptions are great. You just take them off your adjusted gross income. Deductions, you actually have a little bit of a choice. You can claim separately anything that qualifies as a deduction, which are things like interest on your home mortgage, contributions to charity, some medical expenses, some taxes. There's a whole list of them. This is not an all-inclusive list. Or you can take a standard deduction, which is just a fixed amount. So you have to see, can you take off more if you take the standard? Or if you add up all your separate things, are they more than that, in which case you want to take itemized. But you've got to pick one or the other. You cannot pick both. So let's look at an example and decide if this person should itemize. So let's say that you put $2,500 on your home mortgage and interest. You paid $900 to charity, and then you paid $250 for state income taxes. So if you add those three together, you see that your standard deduction, or excuse me, if you add those three together, skipping down here at the bottom, you get $3,650. But the standard deduction in this case is $4,750. So in this case, you would be better off taking the standard deduction because that means you can subtract almost $5,000 off your adjusted gross income, rather than if you itemize, you could only subtract about $3,600. You always want to go with what's more. So in this case, you would want to take the standard deduction because that is a larger amount than if you itemized and added up all of your individual contributions. Okay. One other thing that we're going to look at is how do you pay taxes if you get something like a raise? It's a misconception, and I've heard students say it before, that they don't want to get a raise because that means that they'll be paying more money to taxes than they made in the first place, which actually is not true. So when you get a raise, it's going to be taxed at different levels based on where it falls in the income tax bracket. We have a progressive tax bracket currently in the US where when you first start making money, it's taxed at a lower percentage than when you're making more money, but each chunk of money is taxed at a different rate. So when you get a raise, you need to look and see where it falls on the scale, and the money at each of the income brackets is going to be taxed at that rate. So let's probably makes more sense by looking at an example. Come back to this chart for the math, but let's just jump straight to the example for this one. So D gets a raise, and let's say that her raise is going to increase her taxable income from $80,600 to $80,400. We want to see how much will this increase her taxes. So looking at this example of a tax chart, the first $8,000 that you make, $8,350, it's going to be taxed at 10%. Then all the money that you make from $8,350 up to $33,950 is taxed at 15%. So you're the first 8,000-ish is taxed at 10, then from that point up to 33,950, you're at 15%. Then the money that you make from 33,000 up to 82,250, so the money in between these two tax brackets, that money is taxed at 25%. And then any money that you make from 82,250 up to 171,550 is taxed at 28%. So your money is taxed at different levels as you accrue more of it, but each chunk of money is only taxed at one rate. So again, the first 8,000-ish dollars is taxed at 10%. Whatever you make from 8,000 to about 33,000 is taxed at 15, and so on. So when she goes from 80,600 to 80,000 or 84,000, you see she's going to be skipping over this 25% bracket. When she was at 80,600, she was down here at 15%, and then, or she was at the 25%, and then when she gets to 84, she's going to jump up and be at the 28%. So the money that she makes from the 80,600 to 82,250, where the cutoff is, that's going to be taxed at 25%. And then all the money she makes from the 82,250 up to her new salary amount of $84,000 will be taxed at 28%. So we've got to calculate what portion of her money is still in that 25% category. So we take that cutoff, the 82,250 minus where she was, to see that $1,650 of the raise will be taxed at 25%. And then all the money from the cutoff up to where she ends up, which is $84,000. So $84,000 minus $82,250, which is $1,750, will be taxed at 28%. So part of her raise is still in the 25% bracket. Part of it has moved up to the 28% bracket. So to do the math, we're going to take the income at the lower rate, multiply it times 0.025 to get the tax that she pays on the first chunk of the raise. And then we take the amount in the upper income level, multiply it times 0.028 or times 0.28 to get $4,090, which is at the higher tax rate. Add those together to get her total tax bill. So when her income went from 80,600 to 84,000, so that was a $3,400 raise, she ends up paying $902.50 in taxes. Again, part of the raise was at 25% and part of the raise was at 28%.